All right, good afternoon, and thank you all for joining us today for some updates on the Employee Retention Tax Credit. I'm Jackie Petroselli, the marketing specialist here at MP. For those of you joining us on a webinar for the first time, MP is a full-service human capital management services company offering a suite of products and services including HR, payroll, benefits administration, time and attendance, and compliance. We support our clients with cutting-edge technical solutions, as well as proactive, reliable service and deep HR and payroll expertise. MP is wired for HR and helps clients succeed by tying their operations to their business goals. Your presenter today is MP's VP of Client and HR Services, Paul Carelis. Paul has over a decade of experience in the HR consulting space, working with businesses of all sizes and in all industries. Paul and his team of certified HR professionals at MP assist clients with compliance, training, and full circle HR guidance and support. And with that, I'm going to hand the mic off to Paul to get started.
Thank you so much, Jackie. Welcome, everybody. If it's your first time, welcome to our webinar series. We do these every Thursday on a variety of topics. For those of you who were with us last month in February for the ERTC webinar, you may see some familiar things as a really kind of an updated version of that. But it's amazing how quickly things can move and things can change. You know, in that time, just in a matter of weeks, we've had 103 some odd pages of IRS guidance, a brand new stimulus bill that added some more intrigue and some more details and regulation to the program. So certainly have plenty to talk about. As Jackie said, feel free to utilize the Q&A if you have a question. I'll do my best to answer what we can live, and some of them we may need to do some additional research on or otherwise take a look at and get back to you on, but we will do our best there. Before we kick things off, just a quick legal disclaimer. This is intended to be coming at you from a HR best practices perspective. Please don't take anything we say today as legal advice. For a topic like this, you know, it's also important to know we're not providing financial or tax advice either. Accountants, CPAs, and other people that you work with as part of your tax and financial strategy are crucial allies, especially when it comes to a program like this that we're going to be talking about today. So what will we be talking about today? So we're going to be talking about the Employee Retention Tax Credit Program. We will talk about kind of the differences in eligibility and benefit for both 2020 as well as 2021. We'll discuss some of the key term definitions. We will talk about updated IRS guidance that was released since our last webinar on this topic, as well as the impact of the American Rescue Plan on ERTC. We'll then dive into some of the frequently asked questions that we've been fielding here at MP, as well as some scenarios that hopefully will provide some good guidance for you in your own individual situation. And as I said, we'll do our best to do some live Q&A at the end. Okay. So a few things have changed over the last year. Countless things have changed over the last year, really. But when it comes to the ERTC, it started about a year ago with the first stimulus bill, created the ERTC program, but you never really heard too much about it. And the big reason for that is because when originally drafted and signed into law, they kind of drew a line in the sand and said, we're creating this paycheck protection program and these PPP loans. We're also creating the Employee Retention Tax Credit Program, but businesses were forced to decide between one or the other. They couldn't do both. So based on advice from accountants and tax professionals, especially regarding taxation of the funds, PPP was generally the way to go. So most businesses opted for the PPP, which left the ERTC kind of by the wayside and forgotten about a little bit. Fast forward to late December of last year, in the last couple months of the Trump presidency, there was the Taxpayer Certainty and Disaster Tax Relief Act of 2020. That did some really important things. The most important is probably the fourth bullet here on the screen. it opened up the possibility for businesses within the same tax year to both have a PPP loan and also claim employee retention tax credits. There are rules around that, which we'll talk about, but that was really what brought this back into the spotlight, this ERTC program. In addition to opening up eligibility for PPP borrowers, it also created an additional ERTC program for 2021. It increased the amount of credit available for the 2021 program. It increased the eligibility. It created new wage periods to claim credits on, and also created the opportunity for advanced payments in certain situations. So that was the first big change. And that was just 3 months ago. Then earlier this month, the American Rescue Plan Act of 2021 was signed into law. So whereas the previous stimulus bill created the ERTC program for quarters 1 and quarter 2 of this year, this new bill extended that to quarter 3 and quarter 4 as well. So we're going to have a full year of ERTC. Excitingly, for businesses that are eligible, where the 2020 program was just 1 credit with all 4 quarters kind of accounted and added together, this is essentially 4 ERTC programs. It's a separate measurement and a separate credit for each quarter of the year. So where your maximum per employee credit for the 2020 program is $5,000 per employee, should your stars align just right, you could be getting up to $7,000 an employee per quarter in 2021. So really, it could be as much as $28,000 in an ERTC credit for each employee this year, when all is said and done. The American Rescue Plan also introduced what's known as the severely distressed business category. So this will start in quarter 3, so not until July, but it defines businesses that were severely distressed as having a 90% or greater reduction in gross receipts as compared to the same quarter in 2019. So, hopefully no one on this call has suffered that badly in the pandemic, but for businesses who have, it essentially what it's going to do for those 2 quarters at the end of this year will actually be lifting the cap on wages to claim a credit on. So right now you can claim the credit on up to $10,000 of qualified wages per employee. This would essentially lift that and allow access for businesses to claim credit on more than that $10,000 per worker. So it could be a great shot in the arm for businesses that really need it. They're also introducing what's called recovery startup businesses as an eligible business category. So up until now, any business that had started February 15th of 2020 or later, they were not eligible for employee retention tax credit. They were kind of left out of this. So the recovery startup business is now available. And the way that's defined, and we're still kind of waiting on some of the fine details. We'll be talking about the IRS guidance in a second, I think on the next slide. It's important to note all of that IRS guidance that was released a few weeks ago only pertains to 2020. So we're still waiting on IRS guidance for this year's program that will help clarify a few of the things and a few of the questions that we still have. But from what we know right now, a recovery startup business is defined as a business that started February 15th of 2020 or later and had up to $1 million in gross receipts. For those businesses, they'll be able to claim up to a $50,000 employee retention credit per quarter this year. It sounds like it won't be the same measurements. They won't have to prove a gross receipt decline. They won't have to prove a suspension of operations. They'll be able to claim the credit on wages and get up to $50,000 per quarter as a recovery startup business. So more details on that to come once the IRS provides a little bit more guidance. On the potential downside, the American Rescue Plan also did outline a 5-year statute of limitations for kind of inspection and review of ERTC credit claims. So you want to make sure you just keep all of your record keeping, your payroll records, your justification for claiming the credit. You want to keep those records on file for at least 5 years. They also clarified with all of the other programs, some of which were introduced in the American Rescue Plan, that dollars used on payroll that came from the Restaurant Revitalization Grant, the Shuttered Venues Grant, or extended FMLA are not eligible for ERTC, along with PPP funds as well. Okay, a couple questions came in. I think maybe I'll try to answer some of these live, because sometimes we get to the end and we've got 50 or 60 or 200 questions depending on the topic, and I'll do my best to answer these live. So on the recovery startup business, is it expected or known if that's just for 2021 wages, or is it retroactive to wages paid in 2020? Obviously, the IRS guidance will help clarify that based on my interpretation. And again, I'm just your friendly HR professional. I'm not a tax certified CPA or tax expert by any means, but based on my interpretation and reading the bill, it sounds like it'll be just for 2021. Severely distressed category, is it third quarter 2021 that has to be 90% down, or do months of 2020 qualify? That is yet to be determined. Again, based on my interpretation, it sounded like this doesn't start until third quarter 2021. We're going to talk about the preceding quarter rule. So there's a chance, depending on how the guidance plays out, that you might be able to use the quarter immediately previous. So in this case, second quarter of this year. But we're not certain in terms of retroactive and how you can measure that 90% decline. Because certainly, yeah, if we're allowed to go back into 2020, I bet there are a number of businesses who would qualify as severely distressed when we were in the real throes of the pandemic and the shutdown of businesses. Again, based on how I'm reading it, it looks like it would have to be ongoing and in current quarters, but we'll see on that. We're hoping for IRS guidance sometime soon. Okay, back to the slides. Okay, so as I mentioned before, the IRS did release guidance, 102 pages of it, on March 1st of this year. As I said, it only pertains to the 2020 ERTC program. They've promised us 2021 guidance soon, so keeping our fingers crossed there. But it did provide some really good answers and clarification for a number of questions that we had, and probably things we were speculating on this time last month when we did our last presentation, and really helped. So there was a lot of clarification on what qualifies as suspension of operations, and they even went into some examples. So in terms of mathematically coming up with it, they use a 10% rule in a couple of different areas. So the guidance previous to this had always said if the suspension was more than a nominal impact on the business, but didn't really provide a number to that. In this IRS guidance, they said 10%. So if whatever was interrupted by governmental order and caused you to modify or shut down, if that accounted for 10% of your gross receipts pre-pandemic, then that would be considered more than nominal. Likewise, there was a lot in the guidance about government orders that forced reduced hours. So if your hours were reduced by more than 10%, again, that's considered more than nominal as well. Some other really good examples that were in the guidance about suspension of operations. So there was multiple references to restaurants. They made it very clear that if a restaurant A had to close down their in-house dining, the ability to dine in, that would certainly count, assuming that accounts for more than 10% of their normal gross receipts. Also, if they're at a reduced capacity, say they could only have 25% of their capacity seated in the restaurant, or 40% or 50% or whatever it is, that would count. Also, if the government required them to shut down early or shut down the dining at a certain hour, like I know for a while here in Massachusetts, I believe restaurants had to close dining in at 9 or 9:30. Those things would all count. They did also address some scenarios that didn't qualify. So some of those included a retail store that was able to allow a certain number of customers in. They had to remain socially distanced, and as such, there would sometimes be some customers that would have to wait outside briefly until a customer left, and then they could go in. the IRS ruled in its guidance that that did not count as a qualifying suspension of operations. But they did say if the company or the retailer was forced to shut down again early, that affected more than 10% of their normal business operating hours, that would qualify. They also provided some direction for actually how to go about claiming the credits, and a little bit of it was frustrating, to be honest. So for current ERTC, you can obviously claim the credit on a current 941. You can reduce your tax liability on an ongoing basis, so on and so forth. There is also what's called a Form 7200. So for companies that want to require an advance of their credit, there's a form they can fill out, letting the government know what their credit is going to be, submit that, I believe, via fax, and then have that processed by the IRS and have them advance them a credit and then rectify it on their 941. The guidance for 2020 from the IRS gave the deadlines for filing the 7200 for each quarter, and each one of them was in the past. It was then followed up with a little paragraph that said, we acknowledge that all of the dates we've just provided are in the past, so there is no avenue for using the 7200 for 2020 credits. As such, that paved the way and gave us clear direction for how to go about doing it. So for 2020 credits and for clients that are working with us to claim ERTC, what we're doing is filing a 941X, so essentially amending the relevant 941s for the quarters that we can claim credits in 2020, processing those, and then just waiting for the IRS to process them and send the payment your way. One other thing that was a little bit disappointing that we were hoping was going to simplify the process. Some experts thought that businesses would be able to put all of the eligible ERTC amount just in a fourth quarter 941X and file it all in one filing. Unfortunately, they did address what's known as the fourth quarter rule, but said that credits need to be claimed in the actual quarter that they were realized, with the exception of if you did a PPP loan and part of the PPP loan was not forgiven, and you otherwise have eligible wages, regardless of when that occurred or when the wages were for, you can claim ERTC credit on unforgiven PPP money in fourth quarter. You can dump all that into fourth quarter, but otherwise you have to claim it in the actual relevant quarter. There was also some clarification in terms of owner wages and claiming credit on those. So they said that wages by a partial owner of the business were eligible unless they own more than 50% of a business. So if you're the sole owner of a business, your wages can't be counted for ERTC, or if you own 2/3, but if you only own a quarter or 1/3 or 49% or even 50%, the language from the IRS said more than 50%. So as long as you're 50% or less, you can claim credits for ERTC. There was also more detail and clarification regarding the aggregation rules. So what that means is if you're part of a controlled ownership group, if you have multiple Fed IDs with common ownership, following the kind of typical aggregation rules by the IRS, then you have to count those all as kind of a single entity for ERTC purposes when it comes to counting employees and things of that nature. There was a somewhat exciting development that hits on a couple of these, and really with the suspension of operations. So for businesses, whether or not it's an aggregation where each location is a separate Fed ID, or if it's all under the same federal ID number, if you're in multiple locations, with those suspension of operations and governmental orders, they made it clear that if one of your locations is subject to a governmental order, so let's say you have one restaurant in Massachusetts and another one over the border in New Hampshire. If your Massachusetts location was subject to some sort of governmental regulation that qualifies you as suspension of operations, you're able to claim credit on all locations, even if other locations weren't subject to that same rule. And whether or not you decided to apply those rules uniformly across all locations, you are still eligible for the entire business, which was really nice to hear. Speaking of governmental orders, they did more strictly define it. They said it really had to be a proclamation or something drafted in writing or passed or It couldn't just be a recommendation mentioned in a news conference, for instance. It has to be a true order. And then as I've described, as we've been going through these examples, they did provide some really good scenarios to help answer some of the questions in regards to the gray area. All right, let's see what we've got. Some more questions. For 2021, is the ERTC a fully refundable tax credit? If tax liability is less than the tax credit, the businesses will still get a refund on the difference. Yes, it's a refundable credit. If we claim 2020 ERTC credit for the time in 2020 after the close of our forgiveness period, will that satisfy the concern about using PPP funds? Yeah, so that's a great question. So there's been a lot of questions that we've received about, how do we differentiate our PPP wage spending versus our ERTC eligible wage spending? So definitely it's safe if you had let's say you had an 8-week measurement covered period for your PPP loan, and you used payroll costs on that. Yeah, as soon as that 8 weeks are over, as long as you're otherwise eligible, you can claim ERTC on all of that, as well as time before. So let's say you waited and got your PPP loan in June. You can claim credit starting March 13th, so pay dated March 13th or later, all the way through the end of the year. If PPP is smack dab in the middle, you can claim for, say, first quarter, second quarter, pause in third quarter, and then resume in fourth quarter. Honestly, that's been the biggest, time expenditure in terms of helping businesses is working through that and correctly appropriating and eliminating the PPP time and shifting eligible credits to other time periods. But we do now have a tool that's greatly helping us with that within the last couple of days. So we are now able to speed up that process a bit. Okay. What does government shutdown mean? Good question. So it can mean a lot of things, and the IRS guidance provided some flavor to that. It can mean that the government required your business or your industry to be shut down. It can mean that the government, and this is federal, state, local, city, whatever it is, all are acceptable. It can mean that they caused your business or your type of business to be closed from certain hours or to only operate a certain number of hours per day. It can be that, as I said, certain restrictions that are industry specific. So, saying that a brewery cannot have people, consuming on premises at a bar. It can be a restaurant that's not allowed to have anything but takeout service, or only allowed to have 50% of their capacity for dine-in. One important clarification, and I think we'll get into this in the scenarios a little bit, they talk a lot about telecommuting. So for office environments that, even if they had to be closed, if they were able to shift the majority and, the services that they could provide and the work that they could do was, not impacted more than nominally by telecommuting, then that unfortunately does not qualify. A question here about, let's see. Good question here that unfortunately we don't have an answer to right now. After the 941X is filed, how long is it expected to receive funds? We don't know. We're kind of testing that live right now. What we plan to do is kind of take a look at the transcripts to track it and see the turnaround time based on when we're filing them and when they're processed at the IRS and when the payments go out. I wouldn't necessarily trust any rumors that are floating out there in terms of timeframes, because it's kind of yet to be determined at this point. We're hoping for a short time frame, but we are anticipating that the current year filings, if we can get the credits on the current quarter 941 for the 2021 ERTC, that those should be pretty quick. Okay, a question about if an owner is 100%, is the company itself still eligible? Yes. Yeah, it's just a matter of their wages. So if they're an S Corp and the owner is a W-2 wage earner on the business, their wages would be excluded, but everyone else would be fine. Yeah, sorry if that wasn't clear. what's considered a relevant quarter? Okay, we'll get into that in a moment. And then a question about the aggregation rules we might have to answer offline. Oh, and then one more about PPP and suspension of operations and kind of as regulations get lifted, how that affects it. So this was a bit of a surprise to me. It was in the guidance, and I'm glad that you brought this up. Thank you. There was questions. So let's say there's a governmental order that was in place that restricted a certain type of business from opening. This, for example, let's say a bar. So bars were forced closed in a given state or in a city, and they couldn't have patrons drinking on premises. So obviously they qualify under the suspension of operations. But let's say that regulation is lifted today, or let's say March 1st for purposes of this example. So let's say the order was in effect all of 2020. January and February, it was still in effect, but March 1st, it was lifted and they can kind of resume operations, and there's nothing more than a nominal effect on business now based on that government regulation. What the IRS guidance said was that they're still eligible to claim ERTC for this quarter, but once the regulations are lifted, the wages after that are no longer eligible. So that business, that bar that we were talking about, could claim ERTC on all of their wages for January and February, but after March 1st, once that order is lifted, those wages are no longer eligible. So that is one wrinkle that makes things a little bit trickier as certain regulations and rules are lifted, but something to be mindful of as well. All right, back to the slides. Thank you. These questions are great. Okay, so I believe we discussed these are the two main avenues to be considered eligible. The gross receipts, which differs depending on what year you're talking about, which we'll go over in the next slide, or the operations that were fully or partially suspended, which I think we've defined pretty well. So first thing you want to do is kind of make it to be fully eligible for all aspects of the ERTC and be able to have all of your otherwise eligible wages qualified. You have to determine whether or not you're considered a large employer. And to be considered a large employer, the way that you do that is you look at your 2019 employee count, and you only have to count employees in 2019 that average 30 or more hours per week. Anyone who is part-time, it's not like ACA where you have to count partial employees as half a full-time or a quarter of a full-time employee. You just count the employees that average 30 or more hours per week. And again, for 2019. So if in 2019 you had fewer than 100 full-time employees, you qualify as a small employer. For 2021, that was bumped up all the way up to 500. So as long as in 2019 you had fewer than 500 full-time employees, you qualify. The biggest difference is that for those who are larger and qualify as a large employer, especially for the 2020 program, you can only count wages paid or health costs paid to employees who are not working. So if you had someone who was on furlough, and let's say you were still paying health insurance for that person, kept them on the plan as you should have, you can claim ERTC on that, but you can't claim credit as a large employer in 2020 for wages paid to employees who are working. The gross receipts decline, the definition for that to be qualified, again, for 2020 was a 50% or greater decline when comparing the same quarter in 2020 to 2019. For this year, you only need to show a 20% receipts decline from 2019 to the relevant quarter this year. As you see, there's an asterisk. There is the preceding quarter rule, so you can always be comparing the immediately preceding quarter. So if we're talking about today, that's fourth quarter of 2020 to fourth quarter of 2019 as well. The tax credit, 50% up to $10,000 in 2020, 70% up to $10,000 in 2021. Oh, the slide needs to be updated. I apologize. This was before the latest stimulus bill, but a max credit of employee per employee in 2020 of 5,000. This has now been doubled, where we just extended the program into third and fourth quarter. It can actually be up to $28,000 this year. And then the coverage period for 2020 is March 13th through the end of 2020. And for this year, we did update this portion of the slide. It is now January through December 31st of 2021. So definitions: wage period, depending on eligibility, can be anything between March 13th and January 1st of 2022. Qualified wages are considered salary, commission, tips, similar compensation that are subject to FICA taxes. You can also count qualified health insurance expenses. And that's both employer and employee. So provided it's a pre-tax plan. So what I mean by that is, let's say you have an employee and their health coverage on the bill from the insurer costs $1,000 a month. It's split 50-50 on a pre-tax basis between you and the employee. So that $500 that you're paying can be claimed as eligible health expenses, but the $500 that the employee is paying can be counted as well under this program. Gross receipts are defined as total sales and all amounts received for services, including interest, dividends, rents, royalties, and annuities. So in terms of how to go about figuring that, you look at any given quarter. You want to start with first quarter of 2020 to qualify for those last couple weeks in March, and compare it to the same quarter in 2019. Eligibility is lost. So if you're looking back at 2020 especially, you continue to be eligible even if your gross receipts climbed and weren't quite a 50%. You don't lose eligibility in 2020 until there's a quarter where gross receipts have dropped less than 20% when compared to 2019. And based on IRS guidance, it looks like once that happened, so let's say you qualified in first quarter and second, in third, you lost it. So you could still claim for third quarter because that's the quarter in which you lost it, but then you wouldn't be eligible for fourth quarter in that case. We're still awaiting the 2021 IRS guidance to give us a little bit of insight in terms of how that'll work for this year. And hopefully we get that soon so that we can apply it accordingly for second quarter ERTC. So in our example here, as I just said, if your gross receipts were only 48% of what they were in 2019, you qualify. Let's say they pop up and you're all the way up to 83%, even though you broke the threshold in third quarter, you can still claim it in that quarter. It's just that the following quarter after that, you've lost eligibility. All right, let's see what we got for questions here. Okay, so want to clarify, sorry for any confusion. ERTC, the large employers, so you want to be under those numbers. So large employers are limited in what they can claim in ERTC. It's not that only large employers are eligible. It's if you're under those numbers and not considered a large employer, you have much more free reign about what you can claim for credits. Okay. Okay, moving on. So I know, looks like we've got quite a few nonprofits and tax-exempt organizations that signed up for the webinar today. So just quickly kind of include the checklist and itemized list of what's considered gross receipts for a tax-exempt employer. Gross receipts from all operations, total sales, all amounts received for services, investment income, dividends, rents, royalties, anything received as a contribution, gift, or grant from outside parties, and any amounts received as dues or assessments from members or affiliates. Certainly, you'll want to run those numbers by your accountant if there's any question there. So this is just an example of the report that we have available through iSolved and through our ERTC service. It does break down the wages by pay date, and you can drill down further on the actual report by employee and then by employee by each pay date. But basically what we do is we break down the total eligible wages, the total eligible health contributions, and then claim the credit as appropriate on the percentages up to the maximums. And then we break it down again by quarter so that we claim the right amounts on each respective 941. All right, so you guys have been providing some great live questions, but I just want to answer a few more that we've been getting often over the last several weeks. Okay, first, can you claim the ERTC if you received a PPP loan, and how about a second draw PPP? So yes, the new law allows employers to receive PPP loans, both first draw and second draw, and also claim the ERTC. Again, just provided that they're able to show and document that they're not claiming ERTC on wages paid with PPP funds. And I believe I mentioned it earlier, but it's worth repeating that if you can show that you used your PPP funds within the covered period and before the end of the covered period, you can start claiming ERTC credits while you're still within your covered period. Again, as long as you use 60% or more on payroll costs. And really, if you've already filed for forgiveness from your first PPP loan, you're going to want to take a look at that application and see what you put down as payroll costs. And that's the number that you're going to want to be able to show as excluded from ERTC. So if you had a $100,000 PPP loan and you did the bare minimum and claimed $60,000 as payroll costs on the application, that's kind of what you need to back out for ERTC purposes. If you used it all on payroll costs and your forgiveness application says $100,000 in payroll costs, that's what you're going to want to back out from your ERTC calculation. Next question, does an employer need to prove that a significant decline in gross receipts is related to COVID-19? No, they don't ask for explanation in terms of the reason if you're using the gross receipts eligibility. Obviously, if you're using the suspension of operations, you're going to want to have good notes and records that point specifically to which government regulation and what the effect it had on your business. I think we went over this a little bit a few slides ago, but in terms of determining employee counts for ERTC purposes, you're always looking at 2019, regardless of which ERTC you're claiming credits on, and then just look at employees who average 30 or more hours per week or 130 hours per month and try to come up with an average. This is a question that came in live. ERTC is a refundable advanceable tax credit. So if you file a 7200 form, you can get that money back. And again, we don't know the timelines of that either. I've heard rumors that the time on those are extended too. So in most cases, we've worked with clients and just got the figures on the 941, whether it be for 2020 941Xs or for this upcoming 941 filing next month. That's the way most businesses are going for it, but it is fully refundable. So presumably you will get a check in the mail for the amount of the credit that you're eligible for. Really exciting stuff. I think we've handled this pretty well, but a full or partial disruption to operations is more than a nominal portion of business operations suspended. Again, the IRS further defined this as more than 10% of a business's function. All right, looks like our FAQ brought on some more questions. In 2021, are you still comparing quarters in 2019? Yes. Yep. So whether it's the 2020 program or the 2021 program, whenever you're looking for your figures in terms of declining gross receipts, as well as doing your employee count, your full-time employee count, you're always using 2019 as your reference quarters. If I use PPP for 24 weeks, but only the payroll portion for 9 weeks, can I use the wages after the 9 weeks towards ERTC? Yes, you can. Yep, so you just want to make sure you document that pretty well and have good records that you can show. On my application, my payroll costs were, again, say 60,000 out of my $100,000 PPP loan, and I use those over 9 weeks from June 1st to August 8th, whatever it is, whatever the measurement is, and then after that, you can claim ERTC, yes. All right, good question here. How about wages over 100K? Can you use those wages towards ERTC during the PPP period since those wages were technically not used? I've seen accountants weigh in on this a little bit. Most of them are saying yes. It's a little bit of an administrative burden to kind of pull those figures out, but it does seem permissible under the ERTC based on current guidance. All right, clarification for the 2021 ERTC program. If we did not have reduced receipts of 50% or more in 2020, but in Q1 2021, our receipts are less than 80% of 2019, do we qualify for Q1 2021? Yes. Yep. So if you're in a business that was not eligible based on the 2020 ERTC guidelines, but you are for this quarter, then yep, you can start claiming for this quarter. All right, we hope to receive a shuttered venue operations grant. Good luck with that. It's a great program. Would wages covered by that grant also be excluded from ERTC eligible wages like the PPP is? Yes. Yep. So they didn't, that was specifically included in the new stimulus bill that was just passed a couple weeks ago, the American Rescue Plan. They did clarify that PPP, shuttered venue operations grant, and the Restaurant Recovery Act, any wages paid with either of those programs are not eligible for ERTC. If my revenue was down, we'll assume that's gross receipts, 20% in last quarter of 2020. So yeah, if your gross receipts were down 20% or more in the fourth quarter of 2020 versus the fourth quarter of 2019, using the preceding quarter rule, you can qualify for Q1 2021 ERTC. Great. All right, some more good questions here. Excellent. Good question here. We qualify for Q2 and Q3 of 2020, but Q4 2020 is greater than the 80%. I understand we would still qualify for Q4 2020. If Q1 2021 is down again, can we start ERTC again? That answer is really awaiting IRS guidance on the 2021 ERTC program. I'm hoping so. I'm hoping that they just kind of reset the measures and reset it for the new year. But we don't know with 100% certainty the answer to that just yet. Or at least I don't. How do we apply for the credit? Great question. So if we're talking about 2020, the best way to do that right now is to file a amended 941 or a 941X for the quarters that you're eligible to claim the credits in, and file those with the IRS. And then they should send you a refund check provided the numbers check out. There are basically three options for the 2021 credit. You can claim those kind of as you go and reduce your tax liabilities. You can file one of those 7200 forms to claim in advance, or as most businesses that I'm working with are doing, they're putting it on their 941. So for this quarter, they're putting it on their 941 that we're filing next month, and then claiming the refund there. As I said, MP does have a ERTC service available that includes consulting. So one of our HR experts will work with you, have a consultation call, discuss eligibility, help you make the determination, give you the guidance to help you make the determination whether or not you're eligible, and then using the payroll data that we have, help determine what those credits are, and then actually go about claiming them as well. Okay, so let's do a few quick scenarios. Okay, first, Paul's Auto Repair Service. They were considered an essential business. They weren't required to close, but business declined significantly because there were state mandated stay-at-home orders, travel restrictions. People were hesitant to have people working on their car and getting into their car. People weren't driving as much, so there weren't as many accidents and other mechanical issues that required Paul's company services. That would not count as a suspension of operations because it's basically, consumer sentiment at the end of the day that they were restricted, but the business itself was not restricted. They didn't have to change their hours of operation or not perform a certain service that they were performing before, so that would not qualify as suspension of operations. Sheri's Accounting Services, again, an essential business. Due to state mandated office capacity limits, most employees were working remotely. Some of the employees had worked remotely before, others had not. Based on the IRS guidance that was released this month, that would not qualify. An exception might be if more than 10% of their revenues were derived from, having something going on site where people were coming in and visiting with them, and that for some reason that could not be done virtually. They may potentially have an avenue there to explore, but most likely not. Most telecommuting situations have been shut down. All right, next is Amanda's Burger Bar, a non-essential business. They were required to close for indoor service March through May, and then limited capacity of 25% ever since. They did have increased takeout and delivery, and that helped sustain their business and didn't really have much decline in gross receipts. So what this is basically saying is they don't qualify in gross receipts, but because of the required closures and capacity limits, they do qualify into the suspension of operations, because in normal times that dine-in service accounted for more than 10% of their business. Okay, Max's manufacturing facility, an essential business not required to close, but their supplier of raw materials was required to close due to government order. So this is kind of the wild card third avenue for eligibility. So even if your business itself was not affected by governmental order, if one of your critical suppliers that you need to be able to do your operations was affected and unable to fulfill what you needed them for, that's another avenue for potential eligibility. Next, Jen's Daycare and Preschool. They are an essential business. They weren't required to close. They had a decline in enrollment, a mixture of fear of COVID, as well as parents that weren't working in an office environment or weren't having to work away from home, so they kept their kids at home. Again, this is kind of indirect. It was more the parents' choice rather than a governmental order that was placed on the preschool, at least in this area. That said, if a state or city had a requirement that daycares and preschools could only be at 50% capacity or something like that, that would qualify. But if it's strictly parents choosing not to enroll their kids or send them, then that wouldn't count. But again, then you look at the gross receipts and hopefully have an avenue of eligibility there. Okay, and finally, MJ's Neighborhood Grocery, an essential business. They did have to have social distancing and limit capacity in the store. Sometimes you'd have a couple of people having to wait outside. They had a decrease in gross receipts because of stay-at-home orders and large chain delivery services like Instacart that kind of replaced some of their business. So it sounds like they might have an avenue by gross receipts, but based on the facts that we know here and based on the IRS guidance, they wouldn't qualify under suspension of operations. I just happen to recall here live in reading through the IRS guidance, there was a grocery store example that was interesting where they said, the grocery store was able to operate. They did have social distancing and limited capacity, and they also had to shut down their salad bar and just kind of prepackaged salads. They said that that was most likely not considered more than nominal part of the business, so that didn't count either, having to shut down the salad bar. Just something interesting that I recall being mentioned in the IRS guidance. Okay, so looks like we do have a few more minutes. I know we've been answering questions as we've been going along, but let me see if there are any more here that are relevant. How do we let MP know which option we wish to choose for claiming the credits when filing our 941s? Well, if you were claiming them, each pay period, then you'd want to have been doing that kind of throughout the quarter. So kind of missed the window on that. If you're filing a 7200, definitely let your account manager or your account coordinator know so that we can fill it out correctly on the 941, and so that it doesn't appear that you're trying to double up on your credit. Or if you have your figures and you've calculated them on your own outside of our service, either by yourself or your accountant or whomever, and just need to have those put on the 941, reach out to your payroll contact, your account manager, your account coordinator, and they can help get those on for you. Do you have to be a current MP client to use the tax service to expedite the credits? It depends what information you have available to you. We can certainly, if you're interested, reach out to us. Respond to the email that you'll receive with the recording of this later today, and we can talk about your specific situation. And depending on the data that you have access to, we may be able to help you even if you're not an MP client right now. Just to repeat, you have to back out PPP proceeds from your wages before calculating the credit. Yeah, so what you really have to do is you have to exclude the time period or any wages that you used PPP funds on. And if you're trying to do the math at home, just be warned, it's not as simple as if you're looking to maximize your credits. At least if you paid payroll with PPP from June to August, if you simply back that out from your numbers, you might be missing out on some credits there. What you really need to do is kind of shift the wages that you paid during that time and see if there's credits after the end of your PPP that you can kind of shift that way. So it's a little bit of a complex calculation as if you had eligible wages before PPP as well as after, that you kind of have to work the math there, but we've come up with a way to do it and do it quite well. So but that said, yes, you cannot claim ERTC on any wages paid with PPP funds. Is the credit subject to the affiliation rules if owned by a private equity firm? For PPP loans, if the private equity portfolio had over 500 employees, 300 for round two, they were precluded from getting a PPP loan. I'm thinking most likely yes. And again, you're looking at 2019 for employee size there. But my guess would be yes, but definitely check with your accountant there. Okay, and then finally, what is the calculation to figure out the credit? So I guess the first step is determining what's eligible wages. So again, wages paid that weren't paid with PPP dollars. Then also any pre-tax health, dental, or other Section 125 type expenses. And then you can add those up to $10,000 and claim 50% of it for 2020. So again, up to $10,000 in wages, and then you take 50% of that, or $5,000 that you can claim for each employee. For 2021, similar in terms of what wages and expenses you can count. Main difference is that you're doing it each quarter separately. So you're looking at, for instance, all the payroll you've run this quarter. For those who've earned $10,000 or more, you can claim $7,000 for those individuals. For anyone who's earned less than $10,000 in qualified wages this quarter, you're taking 70% of whatever that number is. And then the measurement resets starting next month, so you can do the program all over again for second quarter, presuming you're still eligible. So it looks like those are the questions, or at least the ones that we can answer live here. You're stuck with me again for another week, but if you're interested in all the aspects of the American Rescue Plan, so ERTC, the new Family First Coronavirus FFCRA leave that was included in the new bill that starts next week, the new COBRA subsidies, which are pretty monumental. Essentially, anyone who could potentially be eligible for COBRA who was involuntarily terminated in the last several months is potentially eligible for 100% COBRA subsidies up until September. So a lot to talk about there. That is going to be the topic next Thursday. That'll be me again. Look forward for those of you who will be joining us to talking to you then. But otherwise, that's today's presentation. I thank you so much for joining us, and we'll hand things over to Jackie.
Awesome. Thanks so much, Paul. Thank you to all of you again for attending this webinar. We hope that you came away with some really helpful information. If you've been on any of our recent webinars, you already know that we're currently offering services to help businesses claim employee retention tax credits and maximize their PPP funds. If you'd like to learn more about how we can help with these topics and more, you can email us at marketing@mp-hr.com or schedule a call with us via the follow-up email. We hope you stay healthy and have a great day, and we'll see you next week.